Every advanced chip designed by Nvidia, AMD, or Apple has to pass one critical step before it ever powers a device or server. It has to be tested, and one company dominates that process, Teradyne. On July 28, Teradyne proved just how critical it has become. Driven by surging AI demand, quarterly earnings per share exploded from around $0.5 a year ago to now almost $2.4. Yet many investors view Teradyne as a cyclical mobile and consumer hardware play. So the big question is Teradyne evolving into the ultimate AI infrastructure gatekeeper, or has the market already priced in the party? Let's find out. My first question is always simple. Can competitors realistically disrupt this business over the next decade? For Teradyne, the answer is probably no. Morningstar rates the company a wide moat built on intangible assets and switching costs. Teradyne designs testing equipment for the world's most advanced chips, a capability that requires decades of engineering expertise and massive research and development investment. The second advantage is switching costs. Chip makers built entire production workflows around Teradyne's hardware and software, so replacing that installed base would be costly and disruptive. What surprised me most is that semiconductor automated test equipment is essentially a duopoly between Teradyne and Advantest, with the two companies controlling more than 80% of the market. Teradyne also has particularly strong relationships with Apple and TSMC, while Advantest has historically been stronger in Nvidia and AMD GPU testing. The key takeaway is simple. Teradyne is not just selling testing equipment. It is embedded inside the manufacturing process of the world's most advanced semiconductor companies. Before we get into the numbers, every chart and every financial metric in this video comes from Fiscal AI. I use this platform for every stock analysis on this channel. Check out the link in the description or pinned comment below for 15% off. Now let's see whether that moat shows up in the returns. Teradyne generates a 19.9% return on invested capital, which is very strong, though not the best in the group. Advantest leads the pack at 60.5%, followed by Applied Materials at 33.7%, then comes Teradyne, followed by the laggard Keysight at 9.1%. Advantest's fiscal year ends in March, so it is reported 1 year ahead of the calendar year peers. Return on invested capital tells us how efficiently management converts invested dollars into pure profit. And a near 20% return on invested capital still points to a highly profitable business with strong competitive advantages. Return on equity shows a similar pattern. Teradyne stands at 20.4%, Advantest leads the pack again at 57.6%, Applied Materials comes in at 35.5%, and Keysight sits at 15.8%. Teradyne is clearly profitable, but Applied Materials and especially Advantest earn superior returns. That makes the growth story even more important. This is where the Teradyne thesis becomes much more interesting. Because Teradyne reported a loss in 2016, I'm using 2017 to 2025 for the historical comparison. Revenue came in at a CAGR of 5.1%, net income came at a CAGR of 10.5%, and earnings per share has grown at a compounded annual growth rate of 13.3% over the last decade. Earnings per share grew faster because Teradyne consistently repurchased shares, including roughly $700 million in 2025. Historically, growth has been roughly in line with Applied Materials, while Keysight grew earnings per share at 31.2% annually. Advantest, shown separately because of its March year-end, compounded earnings per share at a staggering 39.1%. So historically, Teradyne has been solid, not spectacular. But the forward outlook is dramatically stronger. Through 2028, Teradyne's earnings are expected to grow at a CAGR of 63.8%. Keysight comes in at 40%, Applied Materials at 35.2%, and Advantest at 28.8%. That's a major shift from its history as a smartphone cycle stock. Today the core thesis is tied around the AI compute boom, with a 20% compounding robotics segment providing an extra long-term tailwind. Which brings us to the key question: does Teradyne have the financial strength to capitalize on these growth drivers? Teradyne looks very strong on that front. Teradyne holds roughly $300 million in cash and $300 million in debt, so leverage is minimal. In 2025, the company generated about $500 million in free cash flow, giving it a 166.7% free cash flow to total debt ratio, where 10% is the bare minimum. That matters because semiconductor equipment is cyclical. Companies with weak balance sheets often cut investment during downturns. Teradyne has enough cash generation and financial flexibility to keep investing through the downturn. Now we get to the hardest part of the Teradyne story. The moat is wide, AI demand is accelerating, and the balance sheet is strong. So is the stock undervalued? Teradyne trades at a forward price to earnings of 38.5, above its historical median of 23.7, but below the historical peak of 67.1. If we compare this to peers, Applied Materials comes in at 34.7, Advantest at 30.5, and Keysight at 29.7. On PE alone, Teradyne looks expensive. But adjusting for long-term growth using the price-to-earnings growth ratio changes the picture. Teradyne comes in at a PEG ratio of 1.35, Applied Materials comes in at roughly 2.1, Keysight at 1.9, and Advantest at roughly 0.9. So despite the highest PE, Teradyne is not the most expensive stock once expected growth is considered. Advantest still look cheapest on a PEG basis, but Teradyne screens significantly better than Applied Materials and Keysight. So my key takeaway is this. Teradyne is not a cheap stock, but the valuation becomes easier to justify if the AI-driven growth proves to be correct. So is Teradyne the hidden AI winner? I think the answer is possibly yes. Let's quickly recap our 5 key factors. Morningstar rates Teradyne in white mode, driven by cutting-edge test capabilities, switching costs, and a practical duopoly with Advantest. Returns are strong with a 19.9% return on invested capital, though still below Applied Materials and especially Advantest. Historical growth has been solid, but forward growth expectations are extraordinary. With analysts projecting 64% earnings per share growth through 2028 as AI testing demand accelerates. Teradyne has a solid cash position, exceptional free cash flow generation, which provides financial flexibility. The stock trades at the highest PE multiple in the peer group, but a 1.35 PEG ratio suggests a fair valuation. When I put everything together, I don't see a traditional cyclical semiconductor company anymore. I see a business that is increasingly becoming a critical gatekeeper in the AI semiconductor supply chain. The biggest risk is execution. Advantest still dominates GPU testing today, but Teradyne is actively breaking in as a second source supplier for next generation AI chips. The real question is how much market share can Teradyne snatch over the next 3 years? So my conclusion is this: Teradyne appears to be a hidden AI infrastructure winner. What do you think? Would you rather own Teradyne, Advantest, Applied Materials or Keysight for the next 5 years? Let me know in the comments and don't forget to like and subscribe.